Bitcoin is too volatile to be money. The price swings 20% in a month. It crashes, it recovers, it crashes again. No one can plan around it. That's the claim. And the price swings are real. We're not going to pretend otherwise. But there's a comparison problem hidden in that argument. Too volatile. Compared to what? Against the dollar in New York, Bitcoin swings look reckless. But swap that comparison out. Replace the dollar with the naira, and the picture changes. Nigeria's naira loses 30 to 40% of its purchasing power every year. Not in a crash, routinely. There's a second issue. The comparison expects Bitcoin to behave like a fully mature monetary system. But Bitcoin is 15 years old. Every money in history had a volatile early chapter, a period of wild repricing while markets worked out what it was worth. Gold swung wildly after Bretton Woods collapsed in 1971. The dollar had its own volatile century. Bitcoin is 15 years in. Before we look at the actual numbers, let's make sure we're measuring the same thing.
When people say Bitcoin is volatile, they're usually talking about annualized volatility. It's a single number that summarizes how much a price has tended to move over the course of a year. The higher the number, the bumpier the ride. Near zero means very little movement. Much higher, and you're looking at significant swings. For reference, the S&P 500 usually runs around 15 to 20%. Gold, around 15. Bitcoin's earliest cycles hit 140. Now you'll know what you're looking at.
Here's what the data actually shows across Bitcoin's market cycles. In the earliest cycles, 2011 to 2012, annualized volatility ran around 140%. By 2013 to 2016, it had dropped to roughly 100%. Then 85% in the 2017-18 cycle, 65% in 2019 to 2020, 60% in the 2021-22 cycle. The most recent cycle, 2023 to 2025, around 50%. Still higher than established markets, but roughly a third of where it started. Each cycle, lower peaks. The direction is consistent across every methodology that tracks it.
So why does Bitcoin swing so much in the first place? It comes down to two things: a fixed supply and no central bank. In traditional monetary systems, the money supply can expand to meet demand. There's a buffer between demand and price. Bitcoin has no buffer. The supply is fixed at 21 million, and no one can issue more when demand spikes. When demand moves, price does most of the adjusting. That is what price discovery looks like on an open market. The asset working out what it's worth, one trade at a time. As more people hold Bitcoin and liquidity deepens, those swings moderate. That's exactly what the cycle data shows.
Now, here's the comparison the too volatile argument almost never makes. Against the dollar, Bitcoin looks reckless. But against the naira, the bolivar, the lira, the currencies that most of the world actually uses, the math changes. Venezuela, Nigeria, Turkey, Argentina, Lebanon, Zimbabwe. In each of those countries, Bitcoin's short-term swings are a trade-off. But they're a trade-off worth considering when your alternative loses 30 to 40% per year, not in a crisis, routinely. The too volatile argument assumes you have a stable alternative. For most of the world's population, you don't. That's not a minor caveat. It's the whole argument. Here's what the headline never gets to. Bitcoin's price is volatile. Bitcoin's monetary policy is not. The supply cap never changes. No committee votes on it. No election cycle affects it. Fiat currencies look stable day to day, but the rules governing them shift constantly. Inflation targets, emergency interventions, election cycles, central bank discretion. Bitcoin has volatile price discovery and stable rules. Fiat prices look stable. The rules don't. Which system do you actually want? The one where prices look stable but the rules keep changing? Or the one where the price moves but the rules never do?